On the 3rd of November 2025, OpenAI, OAI, announced a landmark agreement with Amazon Web Services, AWS, a 7-year, $38 billion cloud computing contract. Under the deal, OAI will gain access to hundreds of thousands of state-of-the-art Nvidia GPUs, via AWS's EC2 Ultra server infrastructure, with deployment targeted by the end of 2026 and room to expand into 2027 and beyond. Importantly, this marks OAI's largest strategic diversification away from its long-standing, exclusive association with Microsoft's Azure cloud services. With a recent restructuring, Microsoft's exclusivity over OAI's compute supply was removed, allowing OAI to source capacity from other major providers, including AWS. The agreement is part of a much broader infrastructure build-out. OAI has stated commitments on the order of $1.4 trillion, or close to $1.5 trillion in some reporting, in compute capacity and data center infrastructure across multiple partnerships, including with AWS, Google LLC, Oracle Corporation, Nvidia Corporation, Broadcom Incorporated, among others. Why this matters? 1. Strategic cloud diversification. For years, OAI's compute backbone had been largely anchored to Microsoft Azure. This new AWS deal breaks that exclusivity and signals a shift toward a multi-cloud compute strategy. In doing so, OAI gains flexibility, bargaining leverage, and mitigates single supplier risk. The deal helps open up alternative pathways for sourcing the massive infrastructure that frontier AI demands. 2. Massive scaling of compute. Commitment. AI at the frontier is a compute-intensive endeavor. The GPU clusters accessed via this agreement, particularly the latest Nvidia GB200 GB300 chips, will support both inference, live interactions, products like ChatGPT, and training of next-generation foundation models and agentic AI systems, systems that act on behalf of humans. The fact that OAI is committing tens of billions to one provider underscores the scale of ambition. OAI apparently aims to power 30 gigawatts of compute, roughly equivalent to the electricity usage of 25 million US homes, as part of its overall infrastructure goal. 3. Validation of AWS infrastructure. For AWS, this arrangement is a vote of confidence. With the market watching whether Amazon could keep pace in the AI cloud race versus Microsoft Azure and Google Cloud, landing OAI is a major win, both in terms of public signal and likely near-term scaling opportunities. Analysts noted Amazon's share price surged around 5% on the news. 4. Financial sustainability questions. Despite the excitement, the deal also raises flags around sustainability and business model risk. OAI is committing enormous sums, and the question is, can revenue growth keep up? Reports indicate OAI's current revenue run rate is modest compared to these commitments, and losses are mounting. For example, one report cites OAI's commitment to nearly $1.5 trillion in infrastructure commitments, even while the company remains loss-making. In short, the infrastructure bet is immense, and the payoff horizon is uncertain. A closer look at key dimensions: technological and operational. The deal grants OAI access to hundreds of thousands of Nvidia GPUs hosted in AWS data centers, plus the capacity to scale to tens of millions of CPUs for agentic workloads, i.e., large-scale AI agents performing tasks. Target for full deployment by end of 2026, with room to expand further into 2027. AWS's infrastructure clusters topping 500K chips and experience scaling large-scale AI workloads. The agreement covers both inference, serving models to users, and training, building new models, workloads, two very different cost and infrastructure profiles. By spreading its cloud compute sourcing, OAI reduces dependence on a single vendor and gains alternative paths for capacity expansion. Strategic and competitive for OAI, positioning itself not only as a model provider, but as an infrastructure-scale AI company. The alliance helps open competitive comparisons to cloud providers themselves, and allows UA to negotiate from strength. For Microsoft, the restructuring and this AWS deal mark a loosening of Azure's exclusive tie to UA. Microsoft retains a stake, 27%, in UA but loses some strategic lock-in. For AWS, defending its market share in AI cloud infrastructure, demonstrating that it can support the very largest AI players. For the broader AI ecosystem, this deal signals that compute is a scarce strategic resource, with winners and losers in the race to cover infrastructure needs. Financial and risk: the $38 billion deal is large even in today's AI deal environment. Some press reports place UA's total infrastructure commitments near $1.40 to $1.5 trillion. The scale of spending raises concerns. Can customer adoption, product monetization and recurring revenue keep pace with the capital outlays? Some analysts warn of a potential compute bubble. The deal is structured over 7 years, which gives time for scaling, but also commits UA long-term. Cash flow, cost of capital, energy and real estate constraints all become material concerns. Why the timing? Several factors converge to make this moment ripe. UA's recent corporate restructuring freed it from Microsoft's exclusive compute supply, allowing diversification. The AI model training arms race continues. As models get larger and more capable, they demand exponentially more compute, leading to urgency for providers to lock in supply ahead of competitors. Cloud infrastructure providers, AWS in this case, are under pressure to show they can serve the largest AI clients, so landing UA is a strategic win for AWS. Investor markets and press coverage are fixated on both infrastructure spending and whether AI companies can generate sustainable returns. The sheer size of the deal forces public attention. Implications and what to watch for UA. Execution risk: can UA deploy and leverage this GPU/CPU capacity effectively, both technically and operationally, to generate value? ROI timeline: with massive upfront commitments, when will the return emerge? Will new business models, for example, agentic AI, enterprise AI services, scale fast enough? Cost pressures: capital expenditure, ongoing infrastructure cost, power, cooling, networking, and amortization risk are substantial. Competitive dynamics: as UA spreads compute across providers, will coordination/complexity increase, or reduce vendor lock-in? For AWS, and broader cloud/AI ecosystem, AWS will need to deliver on performance, reliability and cost metrics at scale for UA's demands. This will test its infrastructure and economics. Other cloud players, Microsoft Azure, Google Cloud, will react, either by offering better terms, going deeper into specialized AI infrastructure, or pursuing other large AI clients. The deal may accelerate the arms race for AI infrastructure: more data centers, more custom chips, more power grids, raising questions of sustainability and concentration. For investors, the market. The $38 billion figure gives clarity into how much compute infrastructure is valued at in the AI era, and raises questions about whether such levels of spending will lead to commensurate returns. The impact on publicly traded infrastructure/AI hardware companies, for example, Nvidia, may be meaningful. They supply the chips, they benefit from these multi-year capacity commitments. Indeed, Nvidia's stock rose in response. The possibility of an AI compute bubble is on the table. If infrastructure outlays outrun business model viability, some investments may underperform. Concluding thoughts? The UA AWS $38 billion deal is striking not only for its size, but for what it signals: the transition of AI from a novelty or research project to an infrastructure-intensive industrial-scale endeavor. Wei is essentially betting that compute will be the bottleneck, and by locking in massive scale now, it is trying to secure a moat. But big bets come with big risks. The infrastructure commitments are enormous, the power and hardware needs immense, and the business models still evolving. While the deal offers Wei flexibility, scale, and a diversified compute portfolio, the essential question remains, will this compute get turned into value, revenue and sustainable profit? For AWS, the deal is a win, but one that will test whether it can deliver at the next level of scale and performance for frontier AI clients. In short, this is a watershed moment in the cloud AI landscape. How well it pays off will depend on execution, timing and the broader AI market. For now, Wei has made its move, and the world will be watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell so you don't miss the next one.